In Lecture 1, I gave you some evidence to make the point that it's really tough to beat the market consistently. Today I'm going to delve into that a little more because some people reason this way. Every year, they say, some companies do much better than others, and if you do enough reading and watching the business news, then you can identify them in advance. These people think that will translate into doing better than the average guy who doesn't take the time to do much research. Let's think about that. You read a book published, say 10 years ago about a trading strategy that's supposed to work. Maybe it says you should invest in small growth stocks. Then you read an article on the internet that was posted a month ago about a firm called, say, the Small and Growing Company. So you ask some questions and learn that small and growing does indeed fit the criteria listed in the book and on the internet, so you decide to buy. What's wrong with this story? I'll tell you what's wrong. I've never mentioned the price. Small and Growing Company might be a great buy at $10 per share, but it's probably not a good buy at $20 per share. There's nothing new or hard about this. We see it in other markets all the time. A new Mercedes might be a great buy at $30,000, but it's probably not a good buy at $130,000. People who advocate buying a certain class or type of stock usually don't factor in how often stock prices can change. While you're walking around doing your research, the price can adjust to reflect the traits of Small and Growing Company, be they good or bad. Any strategy that claims to pick investments that will outperform other investments of comparable risk without considering the price is automatically suspect. I'll tell you another thing that's wrong with the idea that if you just do enough reading and asking around, then you could do better than the average investor. That conceptualization of the market fundamentally mischaracterizes the nature of the activity. Buying stocks isn't a me against you contest. People tend to think of picking stocks as a game with winners and losers, and in most games, the winner just needs a slight edge over his opponent to win. Yes, competitive games usually feature two competing players or teams. I play you in tennis, or my football team plays yours. In head-to-head competition, the side with a bit more talent or a bit more preparation usually wins. Small edges matter. It's easy to think that if I work a little harder than you at picking stocks, then I'll beat you, just like in other competitions. That's the wrong way to think of it. If you want to think of investing as a contest, then think of it as an information processing contest. The task is to gather information about a company, distill that information into a price, and then buy the stocks with prices that are too low given the available information. What's more, the competition isn't me against you. It's you against the collective wisdom of the marketplace. Now, let's think about how the marketplace produces the stock price we see. Mark Rubenstein, a professor at the University of California at Berkeley, writes that each investor buying and selling, for whatever reason, unwittingly pushes prices to where they reflect that investor's information and analysis. Professor Rubenstein thinks of the stock market as an enormous, continually operating mechanism that records the opinions of millions of investors in continuously changing prices. If you think of the market like this, then it's silly to think that prices can get too far away from fair. After all, aggregating information from lots of individuals has a track record of finding the truth in other fields. Do you remember the tragic story of the USS Scorpion? Sherry Sontag, Christopher Drew, and Annette Lawrence Drew's book, Blind Man's Bluff, The Untold Story of American Submarine Espionage, tells the tale. On May 27, 1968, the submarine was officially declared missing, with her contingent of 99 men presumed dead. All the experts could do was narrow the